How you doing? Let's look at this. So I'm gonna run through buyer. I'm gonna look at it. Okay. So here, Santa Fe Retailing, right? Purchase merchandise as is with no returns from Mesa wholesalers. So we're Mesa wholesalers this time. Credit terms 3, 10, and 60, right? 3% discount if paid within 10 days and 60. Whole things due within 60 days. Invoice price of $24,000. Okay, great. So, and the merchandise had a cost of 16. Assume that both buyer and seller use perpetual. So the first thing we have to do is record the sale. And we need the 2 journal entries, remember, to record the sale. You have to record the actual sale part, and you need to record the cost of goods sold part. So how much was the sale? They sold it for what? $24,000. So we're going to debit accounts receivable $24,000 and credit sales for $24,000. Remember, because it says on credit, so you're going to have accounts receivable because you're the seller this time, and you're going to receive the money, right? They owe it to the seller, and then that's your sales, your revenue. And then we also have to record that cost of goods sold for the $16,000 of inventory that we don't own anymore because we've sold it. So we can take it out of inventory. How do you do that? You credit inventory and you debit cost of goods sold, right? This is cost of goods sold expense, really. Okay, we're putting that in the expense, expensing out the cost of that inventory. Then we're going to pay within 10 days. So within 10 days, we're paying within the discount period. Remember, the discount is on what? The discount's on accounts receivable. So it's 3%, right? Because it's 310. 3% if you pay within 10 days of accounts receivable. So 3 times 24,000 is what? That's your discount, $720. So our accounts receivable, remember, we have to take the whole $24,000 off the books because we're agreeing that that's paid in full. Whatever they pay us with the discount's paid in full. So we're going to take that full $24,000 off the books. Our sales discount is $720, and the cash that we're receiving is the $23,280. Okay? And so remember, this is sales discounts is that contra revenue account for sales. When it's the purchaser, it goes to inventory. When it's the seller, it goes to sales discounts. You just have to remember that, which side you're doing. Now, if they don't take advantage of the discount period, and do they have to take advantage of the discount period? No, right? You don't have to take advantage of the discount period. You might not have the cash, might not be able to do it. So if you're not taking advantage of the discount period, you're just paying off this $24,000 of accounts receivable, and if there's no discount, you're paying how much for this $24,000? $24,000, right? So it just looks like this. Cash, accounts receivable, too much, okay? That's what it looks like. Now, look at this. This is what I want to show you though. So here, right here, accounts receivable, we're paying off $24,000, sales discount is $720, and the cash is $23,280 for the seller, right? Y'all see that? If I scroll back to when we were the buyer last week, if you're the buyer, their accounts payable is $24,000. Their discount, which they put in merchandise inventory, is $720, and the cash that they're paying is $23,280. When you have a problem like this and you're doing both sides, it should match up. They're paying the cash $23,280 as the buyer. The seller is receiving the cash, $23,280 as a seller, okay? So the way they do it is they say, okay, if this is 3%, then this is 97%, but I just do this minus this is this. I think that's easier, but that's what they're doing is saying that's a 97%. So, and then we have if we're not within the discount period, right? So that part's pretty straightforward, right?